If you want to understand where the U.S. retail real estate market is right now, this video is for you. We went through the Q3 2025 earnings calls of 5 major retail REITs, Kimco, Brixmor, Regency, Whitestone, and Site Centers, so that you don't have to. Here's everything you need to know. I'm Brandon Avedikian, the founder of Aspire Commercial, a commercial real estate firm based in Houston, Texas. I started the company in 2023. We've since grown to a team of over 25, and we've done over 350 transactions. So let's get into it, and we're going to start with Kimco. Kimco's quarter proved that scale really matters. They delivered same property NOI growth of 3.6%. They once again raised their guidance, and they reported leasing spreads of 12% on a cash basis. Their Sunbelt portfolio, including Houston, Dallas, and Austin, continues to outperform, with traffic and rent growth outpacing national averages. They signed more than 2.6 million square feet of new leases, and small shop occupancy rose again to 91%. Kimco also made additional progress on deleveraging the company following their merger with RPT last year. So they sold over $600 million of non-core assets and used those proceeds to reduce their debt. They have a major redevelopment pipeline with about $1 billion underway, including several mixed-use projects in high-barrier markets. Management kept the tone confident, tenant demand remains broad-based, credit quality is strong, and bad debt is near record lows. For a large cap REIT, it's impressive to see that Kimco continues to grow NOI organically, which says a lot about the health of the retail sector overall. Next, let's get into Brixmor Property Group, who also delivered a strong quarter with consistent execution across the board. They signed 1.5 million square feet of new and renewal leases this quarter, with 18% blended cash spreads and small shop occupancy at a record of 91.4%. What is really driving the story with Brixmor this quarter is their redevelopments. They stabilized 8 projects at an 11% average yield. That is significant value creation in today's environment and impressive execution by them. And they continue to recycle capital effectively. They sold some lower growth centers and used those proceeds to buy La Centera at Cinco Ranch, a top performing lifestyle center in suburban Houston. I've been there many times. It's an incredible development. And that deal is already paying off with 7 new leases either signed or in progress, with economics above what they underwrote. Financially, they're in great shape. FFO is up 4%, liquidity is at $1.6 billion, and they increased their dividend by 7%. Brixmor's strategy is simple: keep rent spreads high, keep redeveloping, and use capital recycling to upgrade the quality of their portfolio. Brixmor is also showing us that grocery-anchored retail continues to have a lot of strength and momentum. Next, let's jump into Regency Centers, who had a fantastic quarter, perhaps the best in the group. Same property NOI grew almost 5%, and they raised their guidance from between 5.25% to 5.5% for same property NOI growth for the full year. Leasing spreads remained strong at 13% cash and 23% GAAP, and occupancy climbed to 96%. Regency is firing on all cylinders. They're signing new grocers, they're redeveloping top centers, and they are leading the industry in ground-up development. They started $170 million of new projects this quarter, with 2 standouts among that group being Ellis Village, a Sprouts-anchored project in the Bay Area, and the Village at 7 Pines, a Publix-anchored center in Jacksonville. They also bought out their JV partners in 3 centers, 2 of which were in Houston and 1 in New Jersey, and those assets are performing extremely well. Financially, Regency is in great shape, an A-rated balance sheet, leverage around 5x, $1.5 billion in liquidity, and a 7% dividend increase this quarter. Looking ahead, they expect to see mid 3% NOI growth in 2026, which is impressive considering that is on top of the record 2024 and 2025 numbers they've already presented. Simply put, they're building and owning exactly what the market wants: grocery-anchored, necessity-based centers in strong suburban trade areas. Next, let's jump into Whitestone. Whitestone had a strong third quarter and is continuing to show how much Houston and Phoenix benefit from being supply-constrained markets. Occupancy came in at just over 94%, with same-store NOI up more than 4% year over year driven by solid rent growth and almost no bad debt. Leasing spreads were up double digits, and management highlighted continued demand from service and daily needs tenants, exactly the type of users that drive traffic to neighborhood centers. They're also making progress on simplifying their balance sheet by paying down debt and focusing the portfolio on high-income suburban submarkets like the Woodlands, Scottsdale, and Austin. Whitestone isn't chasing flashy redevelopments or national expansion. They are sticking to its niche, local centers that serve affluent trade areas with low new supply, and it is working for them. Lastly, we're going to jump into SITE Centers. SITE had a quiet transitional quarter, you could call it. Their focus right now is more about portfolio transformation than it is about growth. They reported a net loss of $6 million, down from a big gain last year, but that was mainly due to asset sales and the Curbline spinoff. Operating FFO fell to 11 cents per share, down from 81 cents last year. Again, this was expected given all of their dispositions. They've been selling assets and returning capital to shareholders through a series of special cash distributions, with $1.50, a $3.25, and $1 per share special cash distribution this quarter alone. Leased occupancy dropped to 87.6%, reflecting all those recent sales, and they're continuing to sell properties in markets like New Jersey, Colorado, Pennsylvania, and Ohio. The story here is they are in cleanup mode. They're finishing a multi-year transition, shrinking their portfolio, paying down debt, and giving shareholders a large portion of that capital back. It's not a growth story right now, it's a reset, but they're emerging leaner, less levered, and better positioned for whatever comes next. So, what's the big picture for retail real estate? Across the board, occupancy remains high, rents continue to rise, and tenant demand is strong. Even as interest rates remain elevated, most of these REITs are showing organic NOI growth between 3 and 5%, which is very impressive. And while development across the sector has slowed dramatically, that's actually helping fundamentals, with less new supply coming online, giving landlords with existing center better pricing power. In Houston and across Texas, the story is especially strong, with limited new construction, healthy population growth, and a lot of demand from tenants expanding. Kimco, Brixmor, and Regency are showing the strength of scale and balance sheet discipline. Whitestone continues to dominate its niche in high-income local centers, and SITE Centers is wrapping up a major reset to position itself for the next cycle. Putting it all together, you've got a retail market that's stable, healthy, and quietly outperforming expectations. If you found this breakdown useful, make sure to hit the like and subscribe button. Thank you.